LIBOR on the delivery date. These contracts, just like the Fed funds rates, are cash settled. There is no actual delivery. Technically speaking, this is a forward loan that is traded on an exchange, but there's no actual borrowing or lending going on. You just financially settle it. So if we do euro dollar futures, again, let's look at the specs. Each basis points move is worth $25. So if you have an exposure where 3-month interest rates goes up by 1 basis points, you're going to lose $25. Then you're going to short the euro dollar futures by one contract. That's kind of the idea. So-called tick value is 25, which means if you are short one contract, you would make $25 for each basis points increase in the reference rate. If you think about it, if you have $1 million times 0.01% over 4, remember this is a 3-month rate, that's equivalent to 1 basis points move in a $1 million loan. So if you have a $100 million loan, to protect yourself, you need to short 100 contracts. That's the idea. Just for that 3 months. If you go to quotes, typically most of the volume is on the months, contract months that are the ends of the quarters. I mean, we have it for 2 non-quarter months, but there's not much volume on those. Look at this. In the March contract, it's almost 100,000 contract volume. The others are, at most 6,000. But look at the June contract, it's 85,000. You look at the specs, settlement procedures. Actually, let me go back. Trading terminates on the second London business day prior to third Wednesday of the contract month. So assuming Monday the 13th is not a holiday in London, that's the last one. And typically it's T+2. It's the LIBOR on that Wednesday is the reference rate. So this tells us two things. One, by how many contracts I need to short or long to hedge myself. And two, what's market's implied 3-month forward rate? So March contract says $94,775. Hence, the implied 3-month rate for a loan that starts on March 15th is 5.225. $94,205. 5.795. So the market pretty much thinks that 3-month rates are going to increase by about 57 basis points by mid-June. Okay. Let's look at the September contracts. $94,035. So about mid-September. You can look at, but December is going to be a little bit lower than that. So if you look at it, if you plot this, this is the so-called 3-month forward curve. It's going to be upward sloping first, then it's going to keep coming down. For example, by June 2025, market attaches about 3.96%. That means market's saying short-term rates are going to increase in the short term, but we expect it to go down after that. You can hedge short-term LIBOR exposure using the euro-dollar futures. In general, I don't recommend that you hedge long-term interest rate exposures with short-term euro-dollar futures or Fed funds rates futures. And the reason has to do with cash needs of hedging. When you hedge with euro-dollar futures, and suppose the futures contract is losing money, that means your natural position is making money, right? The trouble is, you may not be seeing that money. If you have assets, let's say, that are mortgages, and if the interest rates go up, value of those mortgages go down. I mean, you're going to technically lose money, but the actual, if the interest rates go down, you're going to be technically making money. The value of mortgage goes up, right? But if you're not selling the mortgage itself, you're not getting that cash that quickly. But on the euro-dollar futures part, you're going to be losing equivalent amount of money, and you have to come up with that cash right then and there. We'll talk more about that after the break, spring break. I don't know if I told you guys about the caution story of Deutsche Metallgesellschaft. This was a German company that had a lot of long-term oil contracts, and they hedged it using short-term oil futures. You know, and they did this when the oil prices were high. Well, oil prices kept going down, right? Which means they basically made long-term contracts at high levels. They could get the oil at much lower values, and they're making money on that side. But their hedge was a long position on the oil futures. The hedge was losing equivalent amount of money, but all that cash has to be paid now because there is daily settlement of futures contracts. So all that loss, you have to come up with the cash now. Over the long term, you're going to make up for it. You may or may not be able to finance that loss. And Deutsche Metallgesellschaft couldn't. They actually went bankrupt for a position that was economically not a mistake. They went bankrupt because they couldn't finance to keep the position open. That was the problem. So you need to devise better hedging instruments, and for long-term, either prime rate or LIBOR exposure, it's better to do swaps. Okay? We will hedge long-term LIBOR type exposure using swap contracts. And we'll talk about that after we come back. Those are useful for two things. One, to explicitly hedge long-term variable rate exposure. And two, we're going to actually use that swap rate to price floating rate bonds. Okay? And I will bid you a great spring break. And I'm going to give you guys a long homework based on the fixed income stuff after you guys come back. I don't want you to do anything that I wouldn't do, and I'm not going to open my computer. And if you guys are one of my advisees and you want to talk about it, you can come over and we'll take care of that.